Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, traders. Today, we're diving deep into a fascinating hard-to-borrow situation that recently landed on our screeners, LGCL Limited, ticker LGCL. This isn't just a generic example, we're breaking down the specific data points that make LGCL a stock to understand from a short squeeze perspective. Show LGCL logo/ticker on screen. So, what exactly is LGCL Limited, or LGCL? This company operates in the technology/software application sector with a current market capitalization of $57.03 million. Through its subsidiaries, LGCL provides online agent-centric human capital management services using a platform as a service, or PaaS, model in the People's Republic of China. They specialize in recruitment services, including flexible and permanent employment solutions, primarily through their Columbus platform. Joe Company Overview text. Looking at the recent price action for LGCL, it's been a bit of a mixed bag. Today, the stock is up plus 2.29%, extending its gains over the last 5 trading days to a respectable plus 8.94%. However, zoom out to the last 30 days, and LGCL has seen a significant pullback of minus 34.70%. Volume-wise, today's trading saw 114,600 shares change hands. Compare that to its 30-day average volume of over 5 million shares, and you'll see that today's relative volume is practically 0 times its average, indicating very low trading activity compared to its historical norms. What is cost to borrow and why it matters? Before we dive into LGCL specific cost to borrow data, let's quickly explain cost to borrow for any newcomers. When you short a stock, you're essentially borrowing shares, selling them, and hoping to buy them back later at a lower price. But borrowing isn't free. The cost to borrow, or CTB, is an annualized fee that short sellers pay to borrow those shares. Think of it like interest on a loan. These fees are driven by supply and demand. If a stock is in high demand to be shorted, and there are very few shares available to borrow, the CTB can skyrocket, often well over 100% annually, making it incredibly expensive to maintain a short position. Show CTB explanation graphic. Why this stock is hard to borrow right now. Now, let's talk about why LGCL Limited LGCL has appeared on our hard-to-borrow screener. The numbers are quite striking. LGCL currently has an annualized cost-to-borrow fee of a massive 699.2%. To put that in perspective, that's nearly 700% interest per year just to hold a short position. What's even more compelling is the momentum behind this fee. It's seen a plus 688 percentage point increase over just the last 5 trading days. That's a rapid acceleration in borrowing costs. Highlight CTB numbers on screen. The supply side for LGCL tells a similar story. There are currently only 10,000 shares available to borrow. When you consider the estimated float of 1.6 million shares, 10,000 shares is an incredibly tight supply. Our internal composite squeeze score, which factors in CTB level, momentum, borrow supply, float, and technicals, pegs LGCL at 50.5. That's a mid-range score indicating potential but certainly not a guarantee. Squeeze mechanics explained. So, what does it mean when a stock like LGCL becomes hard to borrow? It means there's a strong demand to bet against the stock, but very few shares are actually available for short sellers to borrow. This scarcity drives up the cost to borrow, sometimes to extreme levels like LGCL's 699.2%. If the stock price starts to rise, short sellers, who are paying these exorbitant fees, might be forced to buy back shares to cover their positions and cut their losses. This buying pressure further pushes the price up, which can trigger more short sellers to cover, creating a cascading effect known as a short squeeze. To short squeeze mechanics animation, it's crucial to understand, though, that a high cost to borrow does not guarantee a squeeze. It can also signal that short sellers have strong conviction in their bearish thesis and are willing to pay a premium to stay short. Dilution risk check. An often overlooked factor in short squeeze potential is dilution risk. For LGCL Limited, our checks show no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B found in the last 90 days. This is a positive sign for any potential squeeze thesis. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. Even if the cost to borrow is sky high, new shares entering the market can provide short sellers with more opportunities to cover their positions without driving up the price as much. This increased supply can effectively offset or even completely negate the buying pressure from a short squeeze, spreading the impact over a larger share count and often leading to price depreciation. So, LGCL having no recent dilution is a plus. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For LGCL Limited, with a 699.2% cost to borrow and incredibly tight borrower supply of only 10,000 shares, here's what astute traders might watch for. Continue to monitor the cost to borrow. Any further acceleration above nearly 700% would be significant. Keep an eye on the shares available to borrow. If that 10,000 number drops even further, it increases pressure. Even LGCL's current low relative volume, any sudden and sustained increase in trading volume, especially coinciding with upward price movement, could signal increasing interest and potential for short covering. The recent 5-day positive price action, despite the 30-day downtrend, is something to observe closely. LGCL Limited LGCL presents an intriguing case study for understanding hard-to-borrow dynamics. Its combination of a sky-high, rapidly increasing cost to borrow and an extremely limited supply of shares available to short creates a unique setup. While a high CTB doesn't guarantee a squeeze, it certainly puts short sellers under immense pressure. Remember, this is about education and understanding the mechanics behind these market phenomena. If you found this deep dive into LGCL informative, please hit that like button, subscribe to the channel for more unique stock analysis, and let us know in the comments what other hard-to-borrow stocks you'd like us to cover next. Keep learning, keep growing, and trade smart.